county level of gasoline prices, just kind of how they regionally affect areas, and you can kind of get a feel for kind of a heat-sensitive map, if you will, of gasoline prices across the United States. The largest factor here is really has to do with taxes in terms of what states are. That's so you can see very clear delineations between states, but also certain areas have certain gasoline requirements. For example, California has much stricter ozone requirements in their fuels, and other metropolitan areas have similar requirements, like New York and even Chicago area. So those add additional expenses. But it is kind of funny where, you know, one would think where oil would be the cheapest, it may not just be the case. I mean, you know, everyone would think, oh, it must be cheapest in Houston, when, you know, just generically, but actually Wyoming has pretty good prices, but a lot of that has to do with the taxes and local regulation. This just kind of gives you a good swath of kind of seeing the geographic disposition, gasoline prices, I should say, because this is basically what's affecting the consumer. And so again, as we kind of break apart from the individual, like the generic barrel of crude, kind of coming into the actual consumer, because this is where it's hitting now, and hitting those areas where it's going to be hitting the consumer, and then of course that's going to be where it affects GDP. And in fact, one of the things I was finding was that for basically every cent change in gasoline prices attributes to, and this is very soft statistics, I mean, as I was going through the sources trying to get this clear, but it translates to roughly about $1 billion in GDP. So if you have a 1 cent sustained increase in gasoline prices, it can translate to about $1 billion cost in GDP. And of course, there's a lot of assumptions going into that, so I wouldn't necessarily, you know, bet my life on that statistic. But still, there's been many economists who've been trying to grasp the effect of rising gas prices, and that's one of them. As we look in terms of this recovery, as oil prices are going up, how that will affect the recovery of our economy and job market. But also something that's interesting is, you know, a lot of times people talk about oil prices, but something that's important to do is adjust it for inflation. And this is going back until the end of World War II up until present day, looking at the price of crude. This is West Texas Intermediate price. And you can see that, you know, we've had inflation-adjusted highs that are similar to where we are today, back in the late 70s in the oil shocks. And so it's, you know, we've been there before, and you can kind of see the collapse in oil prices in the mid-'80s and how for almost 20 years there was a lull in oil prices that a lot of our economy became very centered on that. And then, of course, the 2008 surge in prices that I think everyone can recall with great clarity. And then, of course, the following collapse in oil prices with the 2008 downturn. Certainly, you know, that was a huge move. But even since then, you can see how quickly oil prices have come back with a vengeance in a lot of ways. Kind of coming back to higher prices, hovering above 80, and now sitting just south of 100, but floating around $100. But something that I would like to point out as well, we're kind of going over these kind of general statistics and kind of general economic facts, but something that's been very interesting is that you have two very similar, you know, measures. You have Brent and you have WTI. You know, you probably see these in the media quite a bit. Brent is traded in London, and WTI is quoted at Cushing, Oklahoma, in terms of what price of crude is. Basically, one's more indicative of what's pricing in Europe. It has a lot more exposure to things that are going on in that side of the world, and that's where Brent is. And then you can also see WTI, where, you know, much more kind of North American focused. But typically these go very much in tandem because they're basically, it's measures of the same, it's crude oil. And so they very much map together. But what you can notice is that since 2011, there has been the longest time that in our data set, not just from 2005, but even going back way further, that we've had a departure between the two different types. And so we have a breakdown of a market, and we were trying to investigate exactly what is causing this. As this is, you know, arbitrage in any kind of market, you would expect that they would always map together because they're similar products. And hey, if WTI is cheaper, we'll start shipping it over to Europe, and you'll have balance of price. But certainly with a lot of the sustained higher prices in the price of Brent crude has a lot to do with the fears going on with Iran, the fears going on in Libya and the curtailed production in Libya. A lot has contributed that to kind of the European price quotes, whereas in WTI we've had much more of the economists that we were consulting with. There's almost been a glut of even domestic crude that has been produced, and there's been pooling here, and it's been we've had somewhat of, not necessarily an oversupply, but certainly a larger amount of supply of crude that has allowed for WTI to fall below Brent. But this is significant because we really haven't seen a departure of these two metrics for this extended period of time.
Robert?
Yes, sir.
If I could, and I know you and Steve are both familiar with the economist James Hamilton, who writes an awful lot of good stuff about the oil industry, and I know you've seen his paper. This is, to a certain extent, or a significant extent, a pipeline story. When you talk about what's pooling down here at Cushing, and you look at the big plays that have come on, whether it be Bakken or the heavy crudes up in Canada, we desperately need to change our pipelines and complete some of those, not just Keystone, so it can get out of Cushing and get to the refineries. And there's probably 4 or 5 different pipelines now being proposed to alleviate that. And Hamilton's done quite a bit of research on this, and he really believes that once we solve that, it's an infrastructure problem with pipeline, that spread between WTI and Brent will close. Not completely maybe, but it's certainly where the oil is coming from in this part of the world, and because the pipelines really weren't ready for it, when you consider how fast Bakken and Canada all came on within the last 10 years, that's kind of a big part of this picture here.
Mm-hmm. But it's really interesting to see it graphically kind of play out in front of you, and what John's saying is very clear. I mean, in terms of that pooling effect is very evident in how we can see it, here at those departures in prices. But that's basically as we kind of looking through those oil prices. But okay, so that kind of gives us that more generalized view of, okay, here's kind of the economic lay of the land, but okay, I'm an investor. Now, okay, I have this interesting information. I can look out there and see ConocoPhillips, Anadarko, ExxonMobil. These companies are trading near their 52-week highs, if not above it. They're very, very much. So if you're a value investor, how do you start looking through a sector that is having a commodity that it produces that is going up in price? And that's where we really wanted to kind of start talking about finding the difference in price and finding the difference in value. Sometimes we put them as the same. We kind of equivocate them. But to begin looking at them as a little bit different, because when we come as an investor, when we're shopping as a consumer, price is typically the greatest determinant. But as an investor, we have to be looking more towards value in terms of what's going on, not just in the immediate, but what value and what price might be in the future. And let's